Welcome back to the Genius Malpe channel, the channel that is quickly becoming the place to be if you would like to discuss gold, silver, economics, and what is happening in the world around us with a good conversation, extemporaneous, non-scripted news, and a look at the headlines. So here we go. We're going to get right into it. As I told you in the last video, we were going to talk about some things today that really are painting a picture of what's been happening and just a continuation of the ongoing saga that we are all a part of. And if you look at this first headline, it really kind of sets the tone. IMF warns of possible spiral of waning growth, escalating debt. Global debt rising as emerging markets struggle. IMF says spending cuts could set off cycle. Funds fiscal chief says. Global policymakers need to guard against a self-reinforcing spiral of weakening growth and rising debt that could require a coordinated response by the world's major economies, according to the IMF's top fiscal watchdog. Most countries are on a higher debt path than they were a year ago, the IMF said in its semi-annual Fiscal Monitor report released Wednesday. Fiscal deficits in 2015 to 2016 in emerging economies are projected to exceed levels during the global financial crisis as countries struggle with low oil prices, cooling investor sentiment, and intensifying geopolitical tensions. There you go. That's just the first story, and it really ties into some articles we discussed just a few days ago, as this economic slowdown really seems to boil to the surface of all the news outlets and many of the major financial networks. It's becoming the topic of conversation and quite accepted as something that is going to occur at some point in the very near future. Going along with that theme, we have Fitch downgrading Saudi Arabia. This ties in nicely to the commodity crisis, the implosion of oil around the world. The price of oil just plummeting over the last several months. We've seen jobs lost. We've seen it affect markets in Canada, employment, real estate, spending. It's really affecting all facets of certain economies, especially those that are heavily tied to the production and distribution of fossil fuels such as oil. U.S. ratings agency Fitch has downgraded Saudi Arabia and kept its outlook on the oil-producing country as negative, as the low price of oil continues to take its toll. In a note issued Tuesday, Fitch dropped its credit rating from AA to AA-, warning that the low price of oil, which the ratings agency expects to continue for some time, will have major negative implications for Saudi Arabia's fiscal and external balances. If you're in Canada, or if you're in any other nation, even in the United States, if you're working in the Bakken and you're working in some of the oil fields in Texas, this is a headline, this is an article that should set about some thought processes on what could be happening or what you could be facing in your local or regional economy that is tied to oil. Fears of global slowdown, as Japan is the latest to stutter with debt, now estimated at around 250% of the country's income. Are you guys seeing a theme with just three headlines so far? Three stories so far. Fears of a global slowdown, again, Japan stuttering, and Japan is one of the hardest working, productive countries on the planet. What's happening? Former IMF chief economist Olivier Blanchard has said Japan could face financial collapse. Those are strong words. Its economy will shrink by 0.1% next year, according to the IMF, and it already has the world's highest public debt. State debt is estimated to be around 250% of the country's income. Japan's population has an average age of 44 and is rising fast. As more and more people hit retirement, it is reliant on an ever smaller pool of workers. And as the number of people in work drops, so does their financial firepower. Consumer spending has fallen by $9.7 billion in the last 3 years. Here's a look at Japan's crippling debt problem, debt as a percentage of GDP, projecting that the negative interest rate introduced by the Bank of Japan in February, they thought it would kickstart the economy. I don't believe that it will, and you'll see a headline coming up very soon in today's broadcast of what that negative interest rate policy is doing to Japan's savers and investors and where they're going to preserve their capital. Now, we just saw in the headline it talked about the aging population and the smaller workforce. And I saw a headline, I might have mentioned this recently, but there was a story out for the first time in human history. The population of those over the age, I believe it was 65, those over the age of 65, exceeds the population of people that are under the age of 5. So we're going to have, from this point forward, really because of the lack of people having children, smaller families, and so on and so forth, we are going to, from this point forward, most likely on the planet, going to see an aging population with a smaller population that is a young workforce, and that's going to have consequences as a smaller pool of workers are relied upon to support a growing and larger population of aging workers and retirees. Now, what other countries are at risk? This is all part of the article we just saw in Japan. In the Eurozone, Greece is begging for another debt bailout, and cash-strapped Italy has been forced to cobble together a £4 billion private sector rescue package for its banking sector. In the Italian deal, a bad bank is set to be created, which will take on the toxic loans of the main lenders. However, fears are growing that this plan may be rejected by the European Union, which places very strict rules on what support big banks are allowed to get. China is facing a slowdown as its construction boom comes to an end and oil prices dropped to historically low levels of below $30 a barrel earlier this year. Again, oil affecting a major world economy. Investors spent the start of the year worrying about the future, with the FTSE 100 index dropping into bear market territory, 20% below its previous peak. Some of this fall has since been reversed, but jitters remain. Finding an answer is harder than describing the problem. World leaders are running out of solutions. We'll read that last line one more time. World leaders are running out of solutions. They're going to get desperate. They're going to do desperate things. And at the expense of taxpayers and savers, I assure you. Gold demand jumps in Japan as sub-zero rates spur call for haven. We just talked about what's going on in Japan. A lot of economic troubles there. They're coming up with desperate solutions to these problems, one of them being negative interest rate policies. Well, that's creating a demand for gold in Japan. Sales have increased 35% in the first quarter after the Bank of Japan made that move. Negative rates are seen boosting central bank investor demand. Gold sales surged in Japan. Through March, after the country's move to set negative interest rates sent investors scurrying for a shelter, a further sign that global central bank policy of keeping borrowing costs low or below zero is stoking demand for bullion. Bar sales climbed by 35% to 8,192 kilograms in the 3 months ending in March 31st from a year earlier. Tanaka Kikinzoku Kogyo, KK, the country's biggest bullion retailer, said this in a statement Thursday. That's just one country reacting to negative interest rate policies. Imagine when more and more, because we've seen this discussion and we've talked about it here on the channel, as more and more countries take on negative interest rate policies, more and more central banks begin to implement them, whether it's the euro, whether it happens over in Australia or New Zealand, or whether it happens up in Canada or the United States. You're going to see that absolutely stoke the flames of demand for bullion. And we've talked about this again, another theme we've talked about here on the channel. I apologize if I always repeat myself and reiterate certain key points. But you don't have a lot of time to react. We've talked about that. If and when that were to occur on a global scale or in your country where you live, the the disappearance of gold will happen so quickly, you most likely won't even have the time to react or know that it has happened. It will merely be something you wake up to. It might happen in the evening while you're sleeping, these policies, these trades. And the big wigs, the rich ones, the upper 1%, the upper tenth of 1%, they'll get the news first and gobble up the gold. The bigger investors, the big head honchos on the streets, those are the guys that are going to get the gold. You'll see shops that hold gold probably not even sell it. These are situations you have to consider. Moving on, quarterly investment guide. Gold's $33 billion man, don't be a doubter, keep buying. Saw this article yesterday, didn't have time to get a video up for you guys, but here it is. Gold's first quarter rally was staggering. It was the best quarter for gold in 30 years. The State Street Global Advisors $33 billion SPDR Gold Trust, GLD, took in $7 billion, more than outweighing all it lost in shareholder redemptions in 2014 and 15. The gold ETF is up 15% year to date. Milling Stanley says he could see gold at $13.50 year end. George Milling Stanley, State Street Global Advisors, discusses how gold investors should approach gold and says market conditions are changing in gold's favor. Quick interview, quick video. This article comes from CNBC, one of the major financial news outlets. If you get a chance, you can go search for and find this interview, this video, and watch it yourself. For 40-something years, since I first got into gold investing in the 1970s, people have been saying it doesn't pay a return. Well, guess what? Not much else does these days either. People are charging you to store money. GLD costs less at 40 basis points annually than holding Swiss francs. That's a quote from George Milling Stanley. Now, as many of you know, I am not a proponent of ETFs or the SPDR or any paper gold for that matter. I believe in physical delivery. Talked about this repeatedly on the channel. Buying gold, holding it physically is the way to go, because I believe a lot of these ETFs and these paper gold entities are selling more gold than they actually have in physical ability to deliver. So get gold, get physical. Listen to key guys like this. I believe that it's moments like this when little bits of truth leak out of the financial world, and we see, I don't want to say panic, but we see activity and behavior that we should pay attention to. You know, if you're in a herd of water buffalo on the Serengeti, and you see a couple of water buffalo nervous and scared, and they look up and they're looking in a particular direction and smelling and hearing, and you happen to look over there and you see the crouching eyes of a few lions, you might want to react and start to make appropriate decisions to defend yourself from that coming situation. Does that make sense? So I think what we're all here, we're all in the same herd of humans, and we're seeing certain ones react to certain threats that are starting to rear their head and show themselves in the world economy. And it's at this point, you and I need to defend ourselves. So start reacting, start making decisions, defend yourself from the coming economic situations that we're going to see happening in the future. Surging mining stocks indicate a big move ahead in gold and silver prices. Again, this is happening. This is happening right now. We're seeing surging mining stocks that are indicating a big move. Spring has sprung for precious metals mining stocks. The HUI Gold Stocks Index surged 6.2% on Monday to close at a 14-month high. The HUI chart shows a strong base was built from last summer through this January. And from that base, a new bull market has begun. There's a chart right there. There it is. Look at it. Boom. It pretty much exploded there throughout this year. From 2016's beginning, it really just hit a low there. And then from mid-January, popped all the way up, and it's still on a major trajectory upwards. So for those of you that favor mining stocks, I know some of the viewers on the channel like to dabble in that environment. There you go, some information for you. Now, sometimes we have to question the motives and the honesty and the behavior of banks and major financial institutions. As you know, all of us here on the channel, I believe, have a little bit of skepticism reserved for these major financial institutions. Here's an article. We do this every once in a while. We find an article, we find a story or a court case that somewhat proves that not all these institutions are acting in investors' best interests. Now, Deutsche Bank is settling a U.S. silver price fixing litigation. This is something that I believe we reported it not too long ago. This was something we talked about, I think when the story first broke, might have been last year, and it's now getting into the court cases and happening a little bit further. But Deutsche Bank AG has agreed to settle U.S. litigation over allegations that it illegally conspired with Bank of Nova Scotia and HSBC Holdings to fix silver prices at the expense of investors, a court filing on Wednesday showed. Terms were not disclosed, but the accord will include a monetary payment by the German bank, a letter filed in Manhattan Federal Court by lawyers for the investors said. Deutsche Bank has signed a binding settlement term sheet and is negotiating a formal settlement agreement to be submitted for approval by U.S. District Judge Valerie Caproni, who oversees the litigation. Investors accused Deutsche Bank, HSBC, and Scotiabank of abusing their powers as three of the world's largest silver bullion banks to dictate the price of silver through a secret once-a-day meeting known as the Silver Fix. According to the lawsuit, the defendants distorted prices on the roughly $30 billion of silver and financial instruments traded annually, violating U.S. antitrust law. An HSBC spokesman had no immediate comment. Scotiabank did not immediately respond to requests for comment. The lawsuit is among several in Manhattan Federal Court in which investors accuse banks of conspiring to rig rates or prices in financial and commodities markets. And there below you can see the case numbers and where it's filed, and so on. Now, I'm surprised certain other banking institutions were not named in this, and I'm surprised it hasn't gone further. It very well may. And for those of you out there that might have struggled or been accused of being a conspiracy theorist by friends or others because you believed that there was manipulations taking place in the silver market, I think this story really helps vindicate and validate your previous assumptions and statements regarding conspiracies to suppress or manipulate the prices of certain metals. You know, every once in a while this happens. These stories come out, and it really validates and proves the claims of institutions like GATA, Gold Antitrust Action Committee, and others that are out there stating that there is certain institutions that conspire to control the prices of precious metals. It's happening. It's real. Pay attention to that. And if anything, keep stacking. You've seen some things today. We've talked about some things today that really I hope can motivate the viewers of this channel. The few of you that there are, you know, it's a big world, it's a big planet, there's a lot of people on it, and there's only 7,661 of us so far here on the channel, as I saw today in the most recent subscription number for us. So there's not a lot of us, but what we can do is we can buy what metal we can, keep stacking, and keep emotionally, mentally, and morally prepared for what might lie ahead. Thanks for joining us for today's discussion. Please continue to like, share, and subscribe. Post these videos, and when you get a chance, on your Facebook or whatever social media you tend to frequent, and spread the word to help this channel grow and continue spreading the message of stacking, preparing, and being conscious of what's happening around us. Thanks for being here. Have a good day.